All right, so today we are going to discuss the Strategic Business Reporting International Past paper, and this paper is March 2020. And first of all, we'll be moving toward the second question. Question number one belongs to the consolidation, and there is foreign subsidiary involved in it, and you have not done that thing yet. So we are moving toward the question number two first. And question number two, the requirement is A and B, and in the A requirement there are three sub requirements. Discuss the appropriate accounting treatment of the restructuring cost in the financial statement of Backshot Company for the year ended 31st December 2005. Now for 6 months. Now when you have read straight away that it is restructuring cost, try to bring the relevant standard in your mind. So this is IAS 37. Straight away, try to bring the relevant standard in your mind. IAS 37, restructuring cost. Now, restructuring cost does have the criteria. And the criteria, just try to write the short points, that there should be a formal plan, and that plan should be communicated to all the stakeholders. And if this is met, then the provision should be recorded only for direct amounts. And the criteria for recording the provision is that it should be a present obligation as a result of the past event, and it is probable that this will result in the outflow of economic benefits. And the third criteria is that a reliable estimate can be made. Now, you have written the complete accounting treatment in the form of points. The rest of the thing will be taken up from the case study. We are going to see whether there's a formal plan. Formal plan means whether they are committed to do the restructuring, reorganization. And if they are committed to do the reorganization, the restructuring, whether this has been communicated to all the stakeholders, to the relevant stakeholders. And if the criteria is met regarding the constructive obligation, the provision criteria should be seen, whether there is a present obligation as a result of past event, whether it will result in the outflow of economic benefit, and whether a reliable estimate can be made. And if the provision criteria is met, then the provision for only direct amounts should be recorded. So you have the 6 marks. So first of all, you will be writing IAS 37 is the relevant standard here. IAS 37 discusses the treatment regarding the restructuring cost. In order to record the provision, the following criteria should be met. Then you will be writing present obligation, outflow, and reliable. Okay. In order to record the restructuring provision, the following criteria should be met. And then you will be discussing the formal plan and stakeholders. And then there will be something from the case study whether these conditions are met. Discuss what is meant by good stewardship of a company and whether the restructure and the recognition of the restructuring provision in the financial statement are good example of the good stewardship hallmark. Now, first of all, you need to define the stewardship. Now, within the context of the company, the shareholders are the owners of the company. They have given their investment in the hand of the directors. They are sitting outside the organization. Directors are taking care of the investment of the shareholders. Now, they are responsible for taking care of the investment of the shareholders. They are responsible for running the company in the best interest of the shareholders. They have a fiduciary duty to meet. This is the good stewardship. Now, discuss what is meant by good stewardship. That's fine. Whether the restructure and the recognition of the restructuring provision in the financial statements are a good example of the good stewardship. The shareholders have the interest in the company. They have the shares, And by having the shares, they are interested in the financials of the company. If the company is going fine, they will be buying more shares. If the company is not going fine, maybe they will be willing to sell their shares. So they have to take the decision regarding the share. That is why they are the stakeholders. They are the major stakeholders, key stakeholders within the company. So if the company is recording a provision, if the company is recording a provision, now first of all we'll be looking that within the requirement number 1 whether it meets the criteria of the provision. If it meets the criteria of the provision, then that means they should record the provision, and by not recording the provision, they are actually withholding some information from the stakeholders, from the shareholders. And that is against the principle of the fiduciary duty. For example, if no provision should be recorded, then if they are recording a provision, they are actually misleading the shareholders. So first of all, we'll be looking in the A1 requirement whether the provision should be recorded, and then we'll be discussing in the context of the second requirement. All right, now A3. Discuss briefly whether Mrs. Shaw's acquisition of the equity shares in the Backshot company should be disclosed as a related party transaction. Now we know that related party transaction is IAS 24. Just try to write the number right in front of you so that you remember related party is related to IAS 24. And related party is where either you have the control that is more than 50%, or you have the significant influence, that means in terms of the associates, or the key management personnel. Now, key management personnel means the one who is involved in the planning, decision making, directing the activities of the company. So discuss briefly whether Mrs. Shaw's acquisition of the equity shares in Backshot should be disclosed as a related party transaction. So we have to see whether there is a control, whether there is an associate, that means a significant influence, or there is a context of the key management personnel. So we have just studied the requirement A1, A2, and A3. Now we'll be discussing B requirement. Identify and discuss the ethical issues arising from the scenario which Mr. Shaw needs to consider and what action he should take as a consequence. Now, remember, whenever you have the ethics requirement, you will be having that in the SBR question. You need to be aware of the fundamental principles of ethics. Fundamental principles of ethics. And plus, you should be aware of the ethical threats. Now, ethical issues, when you are discussing the ethical issues are when the fundamental principles are breached and ethical threats have been created. So ethical issues are when the fundamental principles of ethics are breached and ethical threats have been created. Now, what are these fundamental principles? The first one is, so the mnemonic is PICO. So the students who have studied F8 or P7 with me, they already know that I use this mnemonic. Okay. So professional behavior, integrity, competence and due care, confidentiality, and objectivity. Now, professional behavior means following the laws and regulations and avoiding actions that discredit the profession. Now, when you are in accounting profession, you have a lot of things to obey, and there are a lot of expectation from the public accountants that they will not be doing anything which is against the professional behavior. Integrity means to be honest and straightforward in all business and professional relationships. Competence and due care is maintaining the skills and knowledge to provide professional services. Confidentiality is not to disclose the information, which is either not the public knowledge, the information that is already public. For example, if the information has been published within the financial statement. Now, if you're discussing that information, that is not a breach of the confidentiality. Something that has not been disclosed to the public, and you are discussing that information with the public, that is going to be the confidentiality. And objectivity means to be unbiased, impartial, and do not allow influence of others to affect your professional judgment. And then you have 5 ethical threats. So self-interest threat, when you are acting in your own interest. Self-review, when you are reviewing your own work. Advocacy means when you are representing someone. Familiarity threat. And intimidation, when you are being influenced, intimidated, pressurized, threatened. So whenever you have the ethical issue, just like we have over here, identify and discuss the ethical issues. Now, ethical issues will be pertaining to the fundamental principles and related to the ethical threats, arising from the scenario which Mr. Shaw needs to consider and what action he should take as a consequence. So now, the A1 requirement is related to IS 37, so we need to find data related to the restructuring. Then we have the data related to stewardship. Obviously, for that, we need to have the answer of A1 first. And then the third requirement, which is A3, is related to the related party transaction. And then we have to find the data related to IAS 24. In the B requirement, there will be ethical issues. Now, we need to read the question first. Backshot Company has a controlling interest in a number of entities. Group results have been disappointing in the recent years, and the directors of the Backshot Company have been discussing various strategies to improve group performance. So you see, the group results have already been disappointing. That means there is already a pressure over the directors to show some good results. So remember, each and every word of the question is important. You see, discuss what is meant by the good stewardship. So they are responsible to the company's shareholders, and already they have a pressure because the group results have been disappointing. The current financial year end is 31st December. The following personnel are relevant to the scenario. Mr. Shaw, head of accountant of the Backshot Company. Mrs. Davis, chief executive of the Backshot Company. Mike Starr, nephew of Mr. Shaw. Mrs. Shaw, wife of Mr. Shaw. So that means here, discuss briefly whether Mrs. Shaw's acquisition of the equity shares. Now, Mrs. Shaw is the wife of the Mr. Shaw. In Backshot Company should be disclosed as a related party transaction. Now, first of all, we'll be looking how much in terms of percentage the shares are. If it is more than 50%, then straight away it's a control thing. Obviously, that is a related party transaction. If it is like 20 to 50% is a significant influence. If it is less than 20%, then obviously it does not meet the control and the significant influence thing. Then we need to see whether this Mr. Shaw, who is the head accountant, is a key management personnel. Not every accountant is a key management personnel, because someone who is part of the board, someone who is making the decisions, part of the decision making, and can direct the policies of the company, is someone who is a key management personnel. So if Mr. Shaw is a key management personnel, then her wife having the shares will be disclosed as a related party transaction. Otherwise, it should not be disclosed as a related party transaction. So Mr. Shaw, an ACCA member, is the head accountant of the Backshot. He is not a member of the board of directors. So straight away, we got the evidence that he is not a key management personnel. Mrs. Davis, the chief executive of the Backshot Company, is also an ACCA member. During 2005, Mrs. Davis revealed plans to Mr. Shaw of a potential restructure of the Backshot Group, which had been discussed at the board meetings. Now, not everything which has been discussed at the board meeting uh, can be considered as a formal plan, because some discussions are just discussions. The restructuring plans included a general analysis of the expected cost which would be incurred should the restructure take place. These include legal fee, relocation costs for staff, and also redundancy costs for a number of employees. One such employee to be redundant is Mike Starr, is the nephew of the Mr. Shaw. So that means should be communicated to the stakeholders, and all the stakeholders who are relevant to the scenario, relevant to the restructuring. Mrs. Davis is insistent that Mr. Shaw should include a restructuring provision for all the expenditure in the financial statement of the Backshot for the year ended 31st December 2005. It's insistent, that means she is saying that the provision should be recorded. Now we know that in order to record a provision related to the restructuring, first of all, there should be a formal plan, and that should be discussed with the stakeholders. And in order to meet the definition of the provision, there should be present obligation, and the present obligation should result in the outflow of the economic benefits, and it can be reliably measured. Mrs. Davis argues that even if the restructure did not take place exactly as detailed, similar levels of expenditure are likely to be incurred on alternative strategies. So that means they are not sure whether they will be going for restructuring because they have some alternative plans as well. They're saying that if we are not going toward the restructuring, then even then, some expenditure will be incurred in other strategies. Now, other strategies is actually something else. We are talking about the restructuring and the reorganization. It would therefore be prudent to include a restructuring provision for all expenditure. None of the staff other than Mr. Shaw have been notified of the plans, although Mrs. Davis has informed Mr. Shaw that she expects a final decision and public announcement to be made prior to the authorization of the financial statement. So Mr. Shaw is actually, because the Mike Starr, who will be part of the redundancy, is the nephew of the Mr. Shaw, and Mr. Shaw knows that. So Mike Starr is not only stakeholder within the company. Even if Mr. Shaw knows, the stakeholders are not communicated because none of the staff other than Mr. Shaw have been notified. And even there is not a formal plan because they have some alternative strategies in their mind. And they're saying if the restructure did not take place, that means there is no obligation of doing the restructuring. There's no present obligation of doing the restructuring because they're not sure whether they will be going for the restructuring. So the provision criteria is not met as well. So that means there should be no provision recorded within the financial statements. Although they can make the disclosure of the nature of the restructuring, but provision should not be recorded. So first of all, you will be discussing the general criteria, starting with the definition of the restructuring, then writing the criteria of the restructuring, writing the criteria for the provision, and then linking up with the case study by choosing these lines that the outflow is not probable and they are not sure whether they will be going for restructuring or they will be going for the alternative strategy. So this is how you are going to make your answer. Now coming toward the part A2, in which you are supposed to discuss what is meant by good stewardship of the company. Now stewardship is directors are in charge of controlling the company. They have been given the investment by the shareholders, so they are manning the Backshot company, managing it on the shareholders' behalf. So they have the fiduciary duty to act in the best interest of the company and act in the best interest of the shareholders. Now, generally recording something like as it said, and whether the restructure and the recognition of restructuring provision in the financial statement example of the good steward, generally recording something that should be recorded is a good sign of the stewardship. Because if you are disclosing something, if you are including something, that is a sign of responsibility. That is a sign of the openness and transparency, that the directors are not trying to steal any information. They are not going to withhold any information, and they are disclosing it. But as we have discussed in the A1 requirement, that the provision should not be recorded because the criteria is not met. So if they are still recording the provision, then that will be misleading for the shareholders. And that is not going to be a good sign of the stewardship related to A1. Now coming toward the A3 requirement. So we have to read this. Mrs. Shaw is a wife of Mr. Shaw. All right, we know that from the name. The head of the accountant of the Backshot Company. She is not an employee of the Backshot Company and does not know about the proposed restructure. However, Mrs. Shaw recently acquired 5% of the equity shares in Backshot Company. Now, 5% does not constitute a control. So first of all, we have to describe that in order to be a related party, IS 24 describes the following criteria. That is why I am always telling you guys to learn the standard by heart, learn the accounting treatment, memorize it. Because if you have memorized the accounting treatment and then you are referring the standard, it is going to create quite good impression. So neither there is a control by 5% nor there is a significant influence. Now we have to see whether Mr. Shaw is a key management personnel, and we know that he's not because he's not part of the board members. He's not part of the board. He's not involved in decision making, directing the company, and controlling the activities of the company. All right. Mr. Shaw is considering informing his wife of the proposed restructure so that she can make an informed decision as to whether to divest her shareholding or not. Now, restructuring is not a public knowledge yet. And if Mr. Shaw is disclosing that thing to her wife, that means it is going to be insider trading. And insider trading is not only unethical, but it's illegal as well. So if Mr. Shaw is being involved in the illegal and unethical activities, the first principle they are breaching is the professional behavior. Because as an accountant, you are supposed to comply with the laws and regulations. The laws means insider trading is an illegal activity. The regulation means the company does not allow their confidential information to be disclosed to the public. And Mrs. Shaw is in fact a public. So professional behavior, then it's a breach of the confidentiality. All right, so yes, and then related to the 5 ethical threat, it is going to be self-interest because he wants to save her wife's money, his wife's money. That means there is a self-interest threat. All right, so Mr. Shaw is concerned that in short term at least, the inclusion of any restructuring cost would be harmful to the profitability of the Backshot. It is also uncertain in how the market may react should the restructure take place. It is, however, anticipated in the long term, shareholders' value would be enhanced. So this line can be used in the A2 requirement, the good stewardship, and in the longer run, it will increase the shareholder value. So, okay, that's fine. So, but currently, because the criteria is not met, you cannot record the provision, but disclosure of the expected restructuring will make it more clear to the shareholders, and they will be relying on what they have been told by the directors and the accountants. So this is the A, 1, 2, 3, and B requirement, which you should be aware of. Now, first of all, in the B requirement, you will be telling, okay, being an ACCA member, Mr. Shaw is uh, obliged to comply with the fundamental principles of ethics and uh, avoiding the ethical threats. So then you will be telling what professional behavior is, what confidentiality is, and then you will be linking up with the case study. And then you will be also telling the insider trading thing, uh, how it is illegal, and then self-interest, that why he wants to disclose this information to his wife, because they will be taking informed decision and whether to divest the shareholding. So whether to take benefit of that information, which is not yet public knowledge. So in the A requirement, A1, no provision. In the second requirement, by recording the provision, it will be misleading. In the third requirement, it is not a related party transaction. And the B requirement, it is insider trading and professional breach of fundamental professional behavior, confidentiality, and also creating the self-interest. All right, now we are coming toward the question number 3. And again, we have a very big question right in front of us, and for 25 marks. So again, a lot of accounting is involved over here. Let's see. Discuss with reference to the International Financial Reporting Standards whether the directors can classify the stadium as held for sale. Now, straight away, when you have the held for sale thing in front of you, just try to write the number of the standards so that you can write the appropriate treatment. IFRS 5 is the appropriate and relevant standard over here. Non-current asset held for sale and discontinued operations. And we know the requirement was sale CPU. This was the mnemonic. Sale is highly probable, available for immediate sale, locating a buyer, expected to be sold within 12 months. And management is committed to sell the asset, and the price quoted is reasonable, and the decision they have taken is irreversible and irrevocable. They're not going to change it. So these are the requirements. So in the question, we have to see whether this criteria has been met. All of that. Sale is highly probable, available for immediate sale, locating a buyer, expected to be sold, and then management is committed, irrevocable decision, irreversible, the price quoted is reasonable. All those things we have to see. If any of this is not met, then they cannot record the asset as held for sale. Okay, then the A2 requirement. Lyria's accounting treatment of the crowd barrier. Now, crowd barrier is something within the case study. I don't know what it is. Improvements at 31st October 2005. And the principles of the accounting treatment for the sale and lease back of the stadium. And now we know this is IFRS 16. And regarding sale and lease back, the standard says 2 treatments. The first one, which meets the sale and not a sale, according to IFRS 15. And we know if it is not a sale, then there should be the financial liability and the financial asset. And if it is a sale, then right of use should be recorded along with the corresponding lease obligation. The asset should be de-recognized, and the proportion of gain should be recognized in the profit or loss. So, and if the sale proceeds are more than the fair value, and if the sale proceeds as less than the fair value, then we have to see 2 other scenarios. Let's see what is in the case study. And the second one is A2 is layers company accounting treatment of the crowd barrier improvements. Now we will see what is actually in the case study. Now we cannot say this 2 requirement is about what standard. B requirement, whether the amortization of the intangible asset relating to the television program content rights by Lyria company and by the industry are acceptable policies in accordance with IFRS standard. We know that IS 38 is the relevant standard here. And amortization is for those intangibles which have the definite or finite life. And we know that amortization is just like the depreciation. It's actually the allocation of cost over its useful life. So the basis for the amortization can be anything which is suitable, like straight line method, reducing balance method. Even, for example, you have uh, the revenue method. We have done an example as well, if you remember, when we were dealing with the IS 38, that they were having actually a patent. In the year first, they were earning this much amount. In the second year, they were earning this much amount. And based on that, we made the basis, the revenue basis for the amortization. So if the revenue basis makes sense and they are actually synced, they're actually synced with the rights attached to the intangible, then amortization on the revenue basis is allowed. Definitely it is allowed. Otherwise, otherwise without having any integration, the revenue basis is not suitable. Like, for example, if I'll be using my intangible assets straight away 5 years, and I do not know what revenue I'll be earning, how much I'll be earning, then making the revenue basis is not suitable over here. But if I know that in the year one, I'll be earning this much amount, in the year two, I'll be earning this much amount, and those years are not equal, then I can use the revenue basis for the amortization. How to account for the player's contract cost, including the contingent performance conditions, any impairment which might be required to these non-current assets, and whether a player can be considered a single cash generating unit. Now, first of all, if you are thinking that player is a human, can we record human as asset? No, we cannot record humans as an asset. But when you talk about the players, it is actually the contract that we capitalize, not the player. We have already made this discussion when we were in IS 38. So this is all about question number 3. In the A1, you are supposed to discuss IFRS 5. In A2, we will see what it's talking about. In A3, IFRS 16, sale and leaseback, we already know the treatment. We can also write the double entry over here just to make sure that we do not drift. Debit cash, debit right of use, credit asset, credit lease obligations, and credit profit or loss. All right, so let's move to the question. Liria Company is an internationally successful football club. Liria Company is preparing the financial statements for the year ending 31st October, but is currently facing liquidity problems. Okay, that's fine. Problems. Stadium sale and leaseback and improvements. Liria Company has entered into a contract regarding a stadium whereby it will sell the stadium on 30th November 2006. What is the date now? What is the date now? A year end is 31st October 2005. And they will be selling it at 30th November 2006. So how many months is it? When you start your year at 1st November, it will end by 31st October. So that means it is actually 13 months, right? More than 12 months. It's more than 12 months. Yes, 13 months. Okay, and immediately lease it back. Fine. The directors of the Liria Company wish to classify the stadium as a non-current asset held for sale in its financial statements for the year ended 31st October. Now, 31st October started on 1st November 20x4. So that makes it 13 months from now. As they believe the sale to be highly probable at that date, the sale contract requires the disposal of the stadium for its fair value of 30 million. So that means there is no case of more than fair value and less than fair value. They are selling it at fair value. And for Liria Company to lease it back over 10 years. The present value of the lease payment at market rates on 30th November will be 26 million. The market value of the stadium of this type has not changed in several years and is unlikely to change in the near future. All right. The stadium is being depreciated by 5% per annum using the reducing balance method. Now, 5% means 20 years life. Okay, so 20 years life. Now, 20 years life, and they are leasing it back for 10 years. That's fine. In the year to 31st October 2006, it is anticipated that 2 million will be spent to improve the crowd barriers in the stadium. The crowd barrier means to stop the crowd because they are very aggressive, emotional. There is no legal requirement to improve the crowd barrier. So that means there is no obligation. There is no present obligation. Liria company has incorrectly treated this amount as a reduction of the assets carrying amount, and the corresponding debit has been made to profit or loss. So what they have done is debit profit or loss, credit asset. At 31st October 2005, the carrying value of the stadium after depreciation and deduction of the crowd barrier is 18 million. So it is 18 million at 31st October 2005. That means by the year end. That's fine. And the present value of the lease payments will be 30th November 2006. That's fine. Okay, then they will be leasing it back on 30th November. Okay, that's fine. So the first thing is the IFRS 5. Yes, you need to see whether the sale criteria has been met. So the sale is highly probable. Yes, it is mentioned. Available for immediate sale, looks like it is. And the buyer, because there is active market exists, so that's fine. But is it expected to be sold within 12 months? No, it is not. So hence you cannot classify that thing as held for sale under IFRS 5. And leasing is a second scenario which should be discussed separately, and it is not covered by the IFRS 5. So how you will be writing in the exam? IFRS 5 non-current asset held for sale and discounted operation is the relevant standard here. It describes the following criteria to be classified. Classify the asset as held for sale. It is, and then you define the criteria, and then you write from the case study which points are met and which is not. And over here, it is not expected to be sold within 12 months. Hence, it should not be classified under IFRS 5 held for sale. Now, the 2 million now, linear accounting treatment of crowd barrier. So they have done the incorrect treatment by debiting the profit or loss and crediting the assets. So what they need to do now is to reverse the entry. Simply, it's very easy question, very easy part. Debit the asset by 2 million again and credit the profit or loss by 2 million because they does not have any obligation. This looks like that they have charged the impairment. Now, they were not having any obligation to do that, so they cannot record this thing as an impairment. So this is the incorrect accounting treatment, what they have done. Now coming toward the part C, which is the sale and lease back. Now again, according to IFRS 16, there are two scenarios, whether it constitutes a sale according to IFRS 15 and does not constitute a sale according to IFRS 15. If it's not a sale, then financial liability and financial asset should be recorded. If it's a sale, then a right of use should be recorded and a corresponding lease obligation. It seems like this is a sale thing according to IFRS 15 because they are committed to sell the asset and they are transferring the control as well. So then you will be writing debit right of use, debit cash. But there's one thing you need to do. You have to do some adjustments. You have to do some adjustments. You know, the carrying value over here, this is very important. The carrying value, this is for sale and lease back. The carrying value at 31st October is 18 million. and they have deducted 2 million out of it. So first of all, you will be adding back. Now it will be 20 million. Then you need to record the depreciation. Depreciation up to 30th, first of all, the 31st October 20x6. Now what you will be doing is 20 multiplied by 5%, which is going to be 1 million. And they are going to classify it as held for sale on 30th November. So you need another month depreciation, 20 into 5% into 1 by 12. So which is going to be, let me just calculate it, 1 into 1 divided by 12. It's 0.08. Now this will give you the adjusting carrying value. So 20 minus 1, 19, and 19 minus 0.08 is 18.92. This is the carrying value, right? This should be the credit entry for the asset when you will be de-recognizing the asset. All right, now we can pass the double entry. Debit cash, how much they will be receiving? They will be receiving 30 million. Now, debit right of use, we need to calculate that. Right of use. Do you remember the formula of the right of use? The present value of lease obligations divided by fair value into the carrying value. The present value of the lease obligation is 26 million. Fair value is 30 multiplied by 18.92. Now again, let me use my calculator. So 26 divided by 30 into 18.92. It's 16.3. So debit right of use with how much? 16.39, so you can round it, 16.4. Credit asset, how much it is? 18.92. Credit lease obligations. Obligations are present value of lease payments, and the balancing figure will be profit or loss. So you can calculate it how much it is as a proportion. All right, now we have discussed all three requirements. Now we can move further. Okay. Television program content rights. Media company has its own subscription-based television station. As a result, it has material intangible assets which relate to the content rights associated with the television programs. Now, first of all, let's go to the requirement again. What was the requirement? The first one was related to the amortization, whether their policy of the amortization is consistent with the IS 38. And the second one is how to account for the contract cost related to the players. All right. Media company has its own subscription-based television station. As a result, it has material intangible assets which relate to the content rights associated with the television program. You know, the television thing, they have a program, they have the right to use it for a certain number of years, certain time. The budgeted costs of production are based on the estimated future revenues for the television program. Now, whatever they will be generating, the cost will be associated with that. So revenue is synced with the cost. These costs of production are then capitalized as intangible asset and called content rights. So that means the content rights are synced with the revenue. The directors of the media company believe that the intellectual property in the content rights is consumed as customers view the television programs. Consequently, media company currently amortizes the content rights based on estimated future revenues of the program. Now it is fairly fine because their cost is dependent on how much revenue they are earning, and the consumption is how much their programs are being reviewed and the revenue is being generated from that. For example, if a television program is expected to generate 8 million of the revenue in total, and 4 million of that revenue is generated in year one, then intangible asset will be amortized by 50% in year one. That's fine. We already did the example when we were doing IS 38. It's fine because uh, every year they will be having a portion of revenue from that. So that means they are not having a straightaway equal benefit throughout the life. So if that is the case, the straightaway amortization is not a suitable policy. However, the industry practice is to amortize the capitalized cost of the program less its recoverable amount, that means residual value, over its remaining useful life. Now, the industry practice may be fine as well, that if they are using the remaining useful life criteria, like whatever the benefit they will be generating over the life. But their policy of doing it with the revenue structure is fairly fine and should be allowed, is allowed in the standard if the revenue is synced with the benefits generated and the cost, everything. All right, that's fine. This was, you need to discuss whether it is applicable. Yes, it's fine. It is allowed. Now the player contract cost. Players registration contract costs are shown as intangible asset and are initially recognized at fair value of the consideration paid for their acquisition. However, subsequently, player contracts are often renegotiated at cost. Also, player contracts may contain contingent performance conditions where individual players may be paid a bonus based on their success in terms of the goals scored for success of the football team as a whole. These bonuses represent additional contract cost. For impairment purposes, Lydia Company does not consider that it is possible to determine the value in use of an individual player unless the player were to suffer a career-threatening injury and cannot play in the team. That means specific impairment. Players only generate direct cash flows when they are sold to another football club. So usually, yes, the requirement that whether a single player can be considered as a single cash generating unit. No, a single person cannot play the football. Like obviously a team play the football. The team wins. A single player does not win. A single player cannot even play the match himself. So usually the player is the cash generating unit as a team, not the single, because the single player cannot play. Even a single player cannot compete and cannot win. So player is not a single cash generating unit. Team in full is a cash generating unit. Now, what about the additional cost, renegotiated cost? Like sometimes, players when they're performing well, they may ask, no, you are paying us less and you have to pay me more. If that is the case, that there is negotiation going on, then you will be treating that cost as the additional cost. Now, whatever your remaining cost is, for example, you are having a cost of 100, now 50 has been amortized, and now you are negotiating another 20 million, so add 20 into previous 50, and then depreciate it over the remaining useful life. Regarding these bonuses, which are contingent on performance, these are contingent considerations. So you can disclose these contingent considerations within the contract, and when you see the performance targets are met, then those contingent considerations can be recorded. Otherwise, they are going to be disclosed as part of the commitment. And when there is actual obligation, then that obligation will be recorded. So there were 3 questions related to this. How to account for player contract cost, including the contingent performance condition. The player contract cost should be capitalized, and renegotiation cost should be recorded with the remaining cost and spread over the remaining contract life. Regarding the performance conditions, it should be recorded as the contingent consideration. And can a single player be recorded as single cash generating unit? No, it should not be recorded as a single cash generating unit because the player plays in the team and the full team should be recorded as a whole cash generating unit. And the B1 was related to the policy of the intangible, and it looks fine that it is actually consistent with IS 38 because uh, the revenue is synced and linked, integrated with the benefits earned. So that's why it should be amortized on the revenue basis. So remember one thing that IAS 37 has specifically discussed, that no provision should be recorded for future expenses. Now in the second part, A2 part, they were planning to spend 2 million. Now there is no obligation to spend 2 million. There's no legal requirement. So the future expense where there is no obligation cannot be recorded as the provision. So the provision should not be recorded regarding that.